Assalamualaikum warahmatullahi and good day everyone. This video is to replace our session on 14th of December 2021 at 2 p.m. In this video, we will continue to discuss impairments of accounts receivable or trade receivables to be exact. In our last session, I have made a brief introduction to receivables and we have discussed the impairment of account receivable as what generally practiced by businesses. We have also covered bad debt recovered and methods in estimating doubtful debts. Just to recap, we have gone through terms in relation to accounts receivable. Specifically, in this topic, we are looking at trade debtors or trade receivables. We also have highlighted that accounts receivable is an asset simply because it fits the definitions of an asset. We also have discussed factors that reduced the amount collected from our debtors, namely sale discount that we give to our customers to encourage early payment. Goods returned to us by customer also reduce the initial amount of debt that can be collected from customers. And finally, and most relevant to the main topic, is bad debt, which is also known as impairment to accounts receivable. We also have discussed the accounting for bad debt as generally practiced. We have two methods, direct write-off and allowance method. Just to illustrate to you again on the accounting for bad debt under these two methods, say we have this timeline with year ends 1 and 2 and bad debt occurrences during year 1 and year 2. Under direct method or direct write-off method, at year end we do nothing. We are not looking forward or thinking forward about our debt. Once debt became bad, then only we recognize bad debt and write off the bad debt from debtors account. Again, at year end 2, we do nothing, though we do have the thoughts of maybe from experience we might have bad debt in the future, but since we apply direct write-off method, we wait until the debt becomes bad. Once the debt becomes bad, we recognize bad debt and write the amount off from debtors account. Under allowance method, we allow for recognitions of future bad debt, that is, future expense. So every end of year, we estimate for bad debt and recognize bad debt expense, but we do not write it off from debtors account yet because the debt has not become bad yet. We just assume based on experience, which makes it valid, that it might become bad in the future. Once the debt becomes bad, we just need to write it off from debtors account. No need to recognize the bad debt expense anymore. And we can expect that the amount can be the same or different from what estimated, either more or less. Thus, the balance in allowance for doubtful debt account after the write-off can be negative or positive, or on debit side or credit side. At the subsequent year end, we do the same. We make new estimation and recognize bad debt expense. Now, if our previous estimation was underestimated, perhaps now we set a much higher amount of percentage. If previous estimation was over the actual bad debt, we might set at a much lower amount or percentage, but it all depends on our previous experiences and future prospects of our debtors. And once the debt becomes bad, we simply need to write it off from the allowance for doubtful debts account. We have also discussed some of the indicators when our customers not able to pay their debt, as listed here, but of course this list is not exhausted. We have also discussed the accounting for bad debt recovered, that is, when our customer who previously deemed insolvent or went missing, thus his or her debt was deemed uncollectible, has now come back and pay his or her debt. Basically, we have two steps. First, we reinstate the debt because last time we already cancelled the debt from our book of accounts. So depending on the method used, we should either reverse the recognitions of bad debt expense by crediting bad debt expense or reverse the write-off from allowance for doubtful debt account by also crediting it. And then, secondly, we record the receipt of cash and eliminate the debt from accounts receivable. And then we discussed method in estimating doubtful debt, which are two. Either we based on credit sales or based on the age of accounts receivable or the age of debts. As for basing the estimation on current financial year's sale or credit sale, the new estimate will be simply added to the existing balance to get to the new balance in allowance for doubtful debts account. As for basing the estimations on the age of the debts, the new estimate will be the new balance in the allowance for doubtful debts account. So what we need to do is to adjust the existing balance to be equivalent to the new estimate. We have also done an exercise on the estimation based on sale. So now we want to simply finish off with the exercise on estimating doubtful debt based on age of debts. So we have somewhat similar questions. At the end of the current year, we have accounts receivable with a balance of 800,000, allowance for doubtful debts account at 7,500, net sales for the year 3.5 million, and then we have bad debt expense estimated to be 30,000. So need to determine the amounts of the adjusting entry for uncollectible accounts or uncollectible debt, the bad debt expense and adjusted balance of allowance for doubtful debts account, and the net realizable value of accounts receivable. As for the amounts of the adjusting entry for uncollectible accounts or uncollectible debts, we simply need to find the difference between the bad debt expense that estimated, the new estimations of bad debt expense, which is 30,000, and the balance in allowance for doubtful debts account, which is 7,500. So we have the amounts of the adjusting entry to be 22,500. So the adjusting amounts of 22,500 will be the bad debt expense. So that is the amount that we will need to recognize as an addition future expense, and then we need to add that to the existing allowance for doubtful debts account, so that we will get to the balance to be 30,000, i.e. similar or equivalent to the new estimation. So for the net receivable value of account receivable with the bad debt expense estimated at 30,000, we can now determine the net receivable value to be 770,000. What it means is simply that out of 800,000, we are estimating that 30,000 of that 800,000 will not be able to be collected in the future, at least in the next 12 months period, and thus we are anticipating to collect only 770,000 out of that 800,000. What we have discussed so far, for the general practice for accounting for doubtful debt, we can either use direct write-off method or allowance method. Under allowance method, we need to do estimation, and it can be done based on sales or based on age of debtors account. Now under MFRS 9, if you are a public listed company, that makes it mandatory for you to comply with the standard when preparing the financial statements. You must comply with MFRS 9, i.e. the standard for financial instruments, because trade debtors is part of financial instruments, specifically financial asset. And the way we do it mimics the allowance method with estimation made based on age of accounts. So let's now discuss trade receivables under MFRS 9. MFRS 9 is the standard that discusses everything about financial instruments. This standard has replaced MFRS 139 financial instruments, recognition and measurement, with some upgrades on the guidelines. This standard shall be read together with MFRS 132 that gives guidelines on financial instruments presentation, and MFRS 7 that gives guidelines on financial instruments disclosure. Now you can imagine the extent of the discussions on financial instruments, since all the three important subtopics in a typical standard had to be discussed in 3 separate standards for financial instruments. But that is for you to discover later in your advanced file. Since we will be discussing impairment of accounts receivable under MFRS 9, we must first recognize that accounts receivable is part of financial assets. And if you look at the definitions of financial asset, which is in MFRS 132, accounts receivable fit the definition C of financial asset, where it is a contractual right to receive cash or another financial asset from another entity. So for accounts receivable, we are expecting cash payment from our trade debtors. For any financial assets, it should be recognized when and only when the entity becomes party of the contractual provisions of the instrument. So this is what I refer to as specific recognition criteria on top of the general recognition criteria that we have mentioned earlier in this course. For financial instruments, both financial assets and liabilities, they have their classification or categories because basically we have various types of financial instruments. And the classification according to MFRS 9 will also denote the measurement used to carry the value forward. For classification of financial assets, the decision is made based on two things: its business model and the contractual flow characteristics. Briefly, a business model refers to what your intention is for having that financial asset. You may decide to hold the financial asset to collect cash, i.e. either payments or dividends, interest later on, or HTC in short. Or you may decide to hold the financial asset to collect and also to sell it at a later date. The other consideration is the cash flow characteristics of the financial instruments. Is it solely payment of principals and interest, or SPPI in short, or is it not SPPI? So the classification goes like this. If the financial asset has a business model of HTC and cash flow as SPPI, you will classify it under amortized cost or AC. If the financial asset has a business model of HTCS and cash flow as SPPI, you will classify it under fair value through other comprehensive income or FVTOCI. And if the financial asset cannot be classified under amortized cost or fair value through other comprehensive income, it shall be classified under fair value through profit and loss or FVTPL. These classifications also denote the measurements for the carrying value of the financial assets. For example, those classified under amortized cost shall be carried at the cost minus the repayments made to the asset, thus amortized cost. Those classified under fair value through other comprehensive income shall be carried at its fair value, and the changes in value shall be recognized in other comprehensive income. Basically, it means we shall have a reserve created specifically for the changes in its fair value. And those classified under fair value through profit or loss shall be carried at its fair value, and the changes in value shall be recognized directly in profit or loss account or income statement as either gain, that is for increase in value, or loss for decrease in value. For trade receivables under current asset, it shall be generally be classified under amortized cost because at the least we will basically receive the amount owed, which is equivalent to the principal amount. Paragraph 5.1.3 highlights that for trade receivables, it shall be recognized initially at its transaction price if the trade receivables do not contain a significant financing component. Again, this denotes a trade receivables or any receivables that are settled for more than 12 months. So for trade receivables under current asset, we shall recognize it initially at its transaction price, whatever amount owed initially. This is highlighted because for other financial instruments, as stated in earlier paragraphs on the measurement, they shall be initially recognized at their fair value minus their transaction costs to issue the assets or to acquire the liability. Further, MFRS 9 also highlights that all financial assets that are measured at amortized cost, which include the trade receivables, we must apply the impairment requirements, where its impairment must be equivalent to its lifetime expected credit loss. For your information, impairment loss of financial assets is referred to as expected credit loss in MFRS 9, and it can be measured at 12 months ECL or lifetime ECL. ECL stands for expected credit loss. As for trade receivable, we must apply lifetime ECL. Just so that you understand the terms used in MFRS 9 in relation to what we have generally practiced for accounting for bad debts earlier, expected credit loss in the case of trade receivables is equivalent to expected bad debt or estimated bad debt. So when we estimate bad debt and recognizes it in the allowance for doubtful debt, MFRS 9 recognizes it as provision for expected loss. Obviously, bad debt is a loss to the entity. And when we estimate bad debt, the standard requires us to review the age of debt, thus not allowing us to use credit sales as the basis, simply because now we are dealing with trade receivable as financial asset. Thus, we shall review the debt account individually as opposed to generally estimating it from credit sales. Bad debt or uncollectible debt is considered as loss or credit loss to the entity, and we simply estimate because the actual amount at the end of the year is unknown. This is also a character of a provision when you discuss provision under MFRS 137, provisions, contingent liability, and contingent assets later in your FAR 3 or Intermediate 2. For impairment of financial assets, we have a few approaches, but specifically for trade receivables and non-financial entities, a simplified approach impairment is the most suitable. They do not deal with financial instruments on a regular basis, therefore do not require sophisticated credit risk management systems. Therefore, it is suitable for financial assets such as trade receivables and contracts with no significant financing components. This simplified approach is also known as loss rate approach. In practice, for such financial assets, we use provision metrics. Basically, what we do is we segment all receivable according to its credit loss pattern. For example, customer type, geographical locations, type of collateral, etc., etc. Then we set the aging for them, such as those not past due 1 to 30 days, past due 31 to 60 days, and past due 90 or more days. Then we work on the historical data of these financial assets to calculate the loss rate, and this will be the starting point of an estimated loss rate for the future. Historical data may be adjusted to take into account reasonable and supportable information that is available without due cost or effort at the reporting date about the current conditions and forecasts of future economic condition. Thus, perhaps we may also adjust the loss rate. For an example of a provision matrix, let us look at this illustration. This is the historical data of a firm for the month of January for its sales. For this segment, it is assumed that sales are usually made on credit. Therefore, it has a significant balance of trade receivables outstanding at each reporting date. As there is no significant financing component, it recognizes lifetime ECL for all its trade receivable. In real life, the loss rate should be based on data from several months, but it cannot be too old as it may yield outdated results. The receivables are presented based on the receivables aging that are not overdue, overdue 1 to 30 days, overdue 31 to 60 days, overdue 61 to 90 days, and overdue 91 days or more, or even not paid at all. And then, based on historical data adjusted to the current conditions and future economic conditions, we calculate and determine the loss rate. How do we do this? Is by looking at the very end. We have an actual loss of 2,000 ringgit on debt not being paid. Thus, at that point, it is a 100% loss. That is 2,000 over 2,000. This 2,000 ringgit is equivalent to 2% of the total initial amount of debt at 100,000 ringgit, and is equivalent to 4% of the total amount due after 30 days, and is equivalent to 9% of the total amount due after 60 days, and is equivalent to 25% of the total amount due after 90 days. So by analyzing the pattern, we have calculated the loss rate. Basically, we are saying at the very beginning of the sales made, we expect a loss of 2%. After 30 days, whatever amount left unpaid, we will be expecting a loss of 4% in the end. After 60 days, whatever amount left unpaid, we will be expecting a loss of 9% in the end. And after 90 days, whatever amount left unpaid, we will be expecting a loss of 25% in the end. Assuming that the loss rate has not changed, taking into consideration the current conditions and future economic condition, we can apply the loss rate to the current receivables at the reporting date as shown here, and calculate the lifetime ECL by multiplying the loss rate with the amount relevant to the specific aging group, bearing in mind that amounts paid and unpaid after certain days are also estimations. Now basically you can see the resemblance of previous review of age of accounts under the general practice. So it simply shows that yes, for trade receivables, we may use what we already practiced. Just that we are not allowed to base our estimations on sales, and we are not allowed to use write-off method, only allowance method. For the journal entries, it will be the same as general practice under allowance method. Only thing, the terms used will be slightly different as per requirement in MFRS 9. So at the end of financial year 1, for example, assuming that this is the first time that we have trade receivables, so first time estimating credit loss and creating the allowance account. We estimate credit loss and we recognize it as impairment loss expense. And we recognize a provision for future expense, that is bad debt, or expected credit loss, i.e. provision for expected credit loss, or we can use the term doubtful debt if we want to, but only for current trade receivables. In other words, for trade receivable that is under current asset, you may use the term expected credit loss or impairment loss or doubtful debt. But for trade receivable under non-current asset, you must not use the term doubtful debt for your allowance account. Throughout the subsequent financial year, for example, financial year 2, whenever debt becomes bad, we write off the debt from trade receivable accounts and the allowance account. At the end of financial year 2, again, we estimate the credit loss and say this is the second time that we estimate for credit loss for trade receivable, thus we need to adjust the balance of the allowance account, if any, to the new estimate. And for the estimation, we recognize impairment loss expense and adjust the balance in the allowance account. So when doing the adjustment, we will either credit allowance account and debit impairment loss expense account, or we will debit allowance account and credit impairment loss expense. It is all depends on the initial balance and the new estimation amount. For the purpose of presentation, we will present trade receivables under current asset. And here we have a sample from a public listed company in Malaysia, Caring Pharmacy Group Berhad. And next to it, we have a note number 11, which denotes a disclosure with regards to the value of trade receivable shown on the face of the statement of financial position. This is how trade receivables should be presented on the face of the financial statement as per MFRS 132, Financial Instruments Presentation. So if you look at note number 11,